final transfer of wealth is underway. The global distribution of capital is changing direction, and this shift is not symbolic or temporary. It is structural. The systems that once concentrated wealth in a narrow group of financial centers are no longer producing the conditions required to sustain that dominance. Debt levels exceed productive capacity. Financial claims expand faster than real output. Capital circulates within financial markets rather than flowing into durable production. These conditions define a system that has reached maturity and entered decline. Wealth follows structure, not narrative. For decades, the concentration of capital depended on control of settlement systems, reserve currencies, financial intermediation, and global credit creation. Those mechanisms remain active, but they no longer command exclusive relevance. Production, trade integration, and savings accumulation have shifted geographically. Capital formation now occurs closer to manufacturing, logistics, and energy conversion rather than abstract financial activity. The result is a redistribution that proceeds through balance sheets and trade flows rather than public declarations. This transfer is visible in trade surpluses, reserve accumulation, infrastructure expansion, and the internal financing of growth. Regions that convert labor and resources into output retain wealth by reinvesting domestically. They accumulate capital through physical throughput rather than asset appreciation. This process compounds steadily. At the same time, systems dependent on debt expansion and asset inflation retain the appearance of wealth while weakening their foundations. The divergence between nominal valuation and productive capacity grows wider each cycle. The shift does not require systemic collapse to continue. It advances during periods of apparent stability. Capital reallocates quietly as institutions respond to efficiency, reliability, and balance sheet durability. Financial markets price risk according to future capacity, not historical authority. Trade routes adapt, settlement preferences evolve. Reserve behavior adjusts incrementally. Each step appears technical and isolated. Together, they form a directional movement that is difficult to reverse once established. This is why the transfer feels gradual yet irreversible. Financial dominance persists longer than productive dominance, but only until structural incentives realign. When maintenance of existing systems requires increasing intervention, while alternative systems expand organically, the outcome becomes fixed. Wealth migrates toward environments where output supports claims without constant adjustment. The final transfer is not driven by ambition or confrontation. It is enforced by arithmetic. Production anchors value. Trade sustains reserves. Savings enable reinvestment. Where these elements converge, wealth accumulates. Where they diverge, wealth disperses. The current global system reflects that reality with increasing clarity. The movement of wealth eastward is not beginning. It is already in motion, governed by structural forces that operate independently of preference, policy, or sentiment. Away from public focus, the mechanics of global finance are being quietly altered. These changes do not appear as crises or announcements. They take place inside settlement systems, reserve management frameworks, and trade financing structures. Institutions are adjusting behavior in response to long-term structural incentives rather than short-term market signals. These adjustments are technical, incremental, and decisive. Trade settlement is one of the clearest examples. An increasing share of cross-border trade now settles outside traditional clearing hubs. Bilateral and regional arrangements replace centralized settlement routes. Local currency settlement reduces dependency on external liquidity pools. This change does not remove existing systems. It reduces their necessity. When settlement no longer requires a dominant intermediary, leverage shifts automatically. The system redistributes influence through usage rather than decree. Central bank reserve management reflects a similar pattern. Reserves are no longer accumulated solely for yield or convention. They are structured for operational resilience. Diversification across currencies, commodities, and direct trade instruments reduces exposure to external policy constraints. These decisions are implemented gradually through portfolio rebalancing. They rarely attract attention because they follow technical mandates. Yet over time, they change the gravitational center of financial power. Infrastructure financing also reveals hidden realignment. Development banks, export credit agencies, and regional lenders increasingly finance production, energy, and logistics directly. Funding is tied to physical throughput rather than financial abstraction. These institutions bypass traditional capital markets and legacy intermediaries. The result is capital formation anchored to output. Wealth compounds where infrastructure expands. This process operates independently of global market sentiment. Payment systems further reinforce this shift. Domestic and regional payment rails gain scale and reliability. Redundancy replaces centralization. Clearing risk is distributed across multiple nodes. This architecture reduces systemic dependency on any single network. Financial resilience increases locally, while centralized leverage weakens. These systems mature quietly through operational adoption rather than promotion. Once embedded, reversal becomes impractical. Energy and commodity trade adds another layer. Long-term supply agreements increasingly incorporate diversified settlement terms. Pricing remains global, but payment structures vary. Producers prioritize reliability of receipt over convention. Financing aligns with delivery rather than speculation. These practices alter capital flow patterns gradually but permanently. Energy anchors economic power, and its financial plumbing is adapting accordingly. None of these actions are ideological. They reflect institutional incentives under structural pressure. Concentration creates vulnerability. Diversification creates stability. Institutions optimize for continuity. The cumulative result is decentralization of financial authority. Influence disperses as systems evolve to reduce friction and dependency. This is how wealth transfers in practice, not through declarations or confrontation, but through silent redesign of the system's plumbing. Balance sheets adapt, settlement norms shift, financing follows production. Each adjustment appears minor in isolation. Together, they form a durable redirection of capital flow. The hidden system actions now underway ensure that the transfer of wealth proceeds, regardless of public awareness. Wealth transfer follows mechanical rules embedded in how financial systems function. Capital does not migrate because of preference or ideology. It moves according to production, savings, reinvestment, and settlement reliability. These elements form the operating logic of the global economy. When they align, wealth accumulates. When they diverge, wealth dissipates. Modern financial systems allocate claims on future output. These claims take the form of currency, bonds, equities, and credit instruments. For a system to retain wealth, the growth of these claims must remain anchored to growth in real output. When claims expand faster than production, the system compensates through leverage, liquidity support, and asset repricing. This creates the appearance of wealth while weakening structural integrity. Over time, the imbalance becomes self-reinforcing. In mature financial economies, capital increasingly circulates within financial markets rather than flowing into productive capacity. Savings are absorbed by asset markets. Returns depend on valuation expansion instead of throughput. Credit creation sustains consumption and asset prices, but it does not expand underlying production proportionally. This model concentrates wealth temporarily, but erodes long-term balance sheet strength. Debt accumulates faster than income. Servicing obligations absorbs future capacity. In production-centered systems, the mechanism differs. Labor, energy, and capital combine to generate output that feeds trade. Trade produces surpluses. Surpluses accumulate as savings. Savings are reinvested into infrastructure, manufacturing, and logistics. Financial systems support this loop rather than replacing it. Credit expands alongside output, not ahead of it. Claims remain anchored to productive capacity. This alignment stabilizes currency usage, settlement trust, and long-term capital retention. Settlement mechanics reinforce these outcomes. Trade settlement requires reliable payment systems and predictable legal frameworks. When settlement becomes fragmented or politicized, participants seek alternatives. Currency usage follows necessity, not tradition. If a currency reliably clears trade and retains purchasing power relative to production, it is adopted. If settlement introduces external risk, substitution occurs. This process is functional, not discretionary. Reserve accumulation follows the same logic. Reserves exist to facilitate trade and stabilize financial systems. They accumulate where trade surpluses persist and where reinvestment channels exist. When reserves exceed domestic absorption capacity, they finance external claims. When domestic systems absorb capital efficiently, reserves compound internally. Over time, this distinction determines where wealth resides. Financial intermediation amplifies these mechanisms. Systems that prioritize leverage and asset turnover concentrate risk. Systems that prioritize throughput and reinvestment diffuse risk. Capital gravitates toward environments where the relationship between effort, output, and return remains stable. This gravitation occurs automatically through pricing, settlement preference, and long-term allocation. The mechanism is impersonal and consistent. Wealth transfers when financial claims detach from production in one system and remain anchored in another. No authority directs this movement. It occurs through millions of balance sheet decisions responding to incentives. Understanding this mechanism explains why wealth shifts direction without announcement and why the transfer persists once structural alignment changes. History shows that large-scale wealth transfers follow repeatable structural patterns. They occur when the alignment between production, trade, and finance shifts geographically. These transitions are rarely recognized in real time because financial dominance outlives productive dominance. Institutions persist. Currencies remain in use. Confidence lingers. But underneath, the structural base moves. The present moment reflects this historical sequence with precision. The decline of Mediterranean trade powers provides an early example. For centuries, wealth concentrated in city-states that controlled maritime routes and financial intermediation. As trade routes expanded and manufacturing shifted northward, productive capacity moved away from these centers. Financial institutions remained influential, but the underlying flow of goods and energy no longer passed through them. Over time, wealth followed production. The transition occurred through trade rerouting, changes in settlement practices, and reinvestment of surplus in new regions. A similar process unfolded during the rise of Northern Europe. The Dutch Republic accumulated wealth through trade efficiency, shipbuilding, and financial innovation. For decades, its financial system dominated global commerce even as productive advantages narrowed. Eventually, industrial capacity and energy access expanded elsewhere. Britain absorbed production, controlled resources, and reinvested surpluses into infrastructure. Financial influence shifted after the productive base had already moved. Currency dominance followed output, not the other way around. The 19th and 20th centuries repeat the pattern. Britain's financial system remained central after manufacturing leadership declined. Global trade continued to clear through British institutions long after relative productivity weakened. Debt expanded, claims multiplied. The transfer completed only when industrial output, energy production, and capital formation crossed the Atlantic. The United States accumulated wealth through manufacturing scale, internal infrastructure, and reinvestment. Financial dominance persisted as a reflection of that productive base. In each case, the sequence remained consistent. First, production and trade efficiency shifted. Then savings accumulated in new centers. Financial systems adapted to serve those flows. Only later did reserve practices, settlement norms, and institutional authority adjust. The transition never required confrontation. It unfolded through incentives and arithmetic. Regions that converted labor and resources into output retained wealth. Regions that relied on financial claims without proportional production saw influence erode gradually. These historical transitions were not smooth. They involved long periods where legacy centers appeared dominant despite weakening fundamentals. Asset values remained high. Institutions retained prestige, but capital formation told a different story. Infrastructure investment, energy control, and trade expansion occurred elsewhere. Over time, financial gravity followed these realities. The current global environment mirrors this pattern. Production capacity, trade integration, and infrastructure investment have expanded decisively outside traditional financial cores. Savings accumulate where reinvestment capacity exists. Financial systems adapt to serve those flows. The process reflects history with precision. Historical echoes do not predict events. They confirm structure. Every major wealth transfer followed the same mechanical logic. Geography changed. Technology evolved. The principle remained constant. Wealth follows production reinforced by trade and reinvestment. When those elements relocate, financial dominance eventually follows. The present moment fits squarely within that historical continuum. When the structural conditions for wealth transfer are established, the consequences unfold with consistency. These outcomes are not reactions to headlines or policy announcements. They are the mechanical results of how capital responds to productivity, balance sheets, and settlement reliability. Once the underlying alignment changes, the system enforces adjustment across multiple layers simultaneously. The first consequence is a persistent divergence in capital availability. Regions losing structural dominance experience tighter capital formation relative to economic need. Credit remains abundant in nominal terms, but its effectiveness declines. Increasing volumes of capital circulate within financial markets rather than financing productive expansion. This reinforces dependence on asset valuation rather than output growth. Over time, financial systems allocate more resources toward maintenance of existing claims than creation of new capacity. In contrast, regions gaining structural weight experience capital deepening. Savings convert into infrastructure, manufacturing capacity, logistics networks, and energy systems. Investment produces throughput rather than price appreciation. Financial intermediation remains subordinate to production. This allows capital to compound without requiring continuous intervention. The result is balance sheet resilience rather than expansion through leverage. A second consequence emerges in trade dynamics. Trade surpluses consolidate where production efficiency and logistics integration are strongest. Deficits persist where consumption exceeds output. These imbalances shape reserve accumulation. Surplus regions recycle capital internally or deploy it through long-term strategic investment. Deficit regions finance consumption through increasing claims on future output. This arrangement sustains itself only while confidence remains intact. Over time, arithmetic asserts dominance. The third consequence involves currency behavior. Currencies linked to expanding productive systems gain functional relevance through settlement and reserve use. This does not require displacement of existing currencies. It reduces exclusivity. As settlement diversifies, financial influence disperses. Currency demand aligns with trade necessity rather than historical convention. This adjustment occurs gradually, but becomes durable once embedded in contracts and payment systems. Financial markets also reflect structural consequence. Volatility increases where asset prices depend heavily on liquidity conditions rather than cash flow generation. Stability emerges where assets are supported by physical throughput and long-term demand. Capital markets differentiate based on structural backing, not promotional narratives. Risk pricing becomes more discriminating as global capital reallocates. Another consequence is institutional adaptation. Legacy financial institutions adjust toward preservation. Balance sheets emphasize risk management over expansion. Regulation intensifies to stabilize systems under strain. Meanwhile, emerging financial institutions focus on scale, integration, and capacity building. These institutional paths diverge structurally, reinforcing the broader transfer. The final consequence appears in geopolitical and economic influence. Control over production inputs, energy flows, and logistics networks translates into negotiating leverage. This leverage does not rely on coercion. It arises from necessity. Trade requires access. Financing follows reliability. Influence consolidates where systems function efficiently. These consequences are not imposed. They are activated by structure. Once production, savings, and reinvestment concentrate elsewhere, wealth follows with certainty. Financial dominance adjusts after the fact, not before. The system enforces rebalancing without regard for preference or identity. Structural consequence is the mechanism by which wealth completes its transfer. Structural transfers of wealth unfold over long periods, then accelerate abruptly. This acceleration does not result from sudden decisions or external shocks. It emerges when parallel systems reach sufficient scale to operate independently. Once that threshold is crossed, timelines compress automatically. Processes that once took years begin to occur simultaneously across finance, trade, and settlement. The system shifts from a gradual adjustment to rapid realignment. In early stages, change appears manageable. Legacy systems continue to function. Confidence remains anchored in familiarity. Capital flows adjust at the margins. Trade experiments with alternative routes. Settlement diversification remains partial. These movements appear reversible because dependency persists. However, underneath this apparent stability, capacity builds elsewhere. Infrastructure expands, payment systems mature. Legal and regulatory frameworks adapt to local needs. Redundancy replaces reliance. As capacity accumulates, dependency declines. At that point, adoption accelerates without coordination. Firms choose efficiency over convention. Institutions choose resilience over concentration. Settlement moves where friction is lowest. Financing follows throughput rather than reputation. These decisions occur independently, yet their timing overlaps. Compression emerges because the same structural incentives act across all participants simultaneously. Confidence adjusts rapidly once alternatives prove reliable. Financial dominance depends on necessity. When necessity disappears, dominance erodes quickly. History shows that currency use, reserve behavior, and trade finance remain stable until substitution becomes operationally trivial. Once that condition is met, adjustment accelerates. Contracts renew under new terms. Payment norms shift. Capital reallocates in clusters rather than increments. This compression produces the illusion of sudden change. Observers interpret acceleration as shock, but it reflects delayed recognition. The underlying process has already occurred. Capacity is already built. Systems already function. The visible transition marks the moment when adoption reaches critical mass. From that point forward, reversal becomes inefficient. Time compression also affects legacy systems internally. As external reliance decreases, internal stress increases. Financial systems built on scale and centrality experience declining throughput. Fixed costs rise relative to activity. Intervention replaces organic growth. Policy response cycles shorten. Each measure produces diminishing stabilization. Pressure accumulates faster than adjustment capacity. The interaction of external expansion and internal saturation compresses timelines further. One system grows by absorption, the other contracts by redistribution. Neither requires coordination. Both follow structural arithmetic. The overlap between expansion and contraction reduces the duration of transition phases. What once unfolded over generations now occurs within a compressed historical window. Historical cycles confirm this pattern. Long periods of accumulation precede short periods of transfer completion. Financial dominance persists until it does not. The moment of transition appears abrupt, only because observation lags structure. The current environment reflects this compression clearly. Parallel financial, trade, and settlement systems already operate at scale. Redundancy exists. Alternatives function daily. The remaining barrier is habit, not capability. Once habit yields to efficiency, acceleration becomes unavoidable. Time compression does not announce itself. It becomes visible only after alignment has shifted. By then, adjustment proceeds rapidly and broadly. This is not a matter of if, it is a matter of sequence. The system advances toward completion once structure permits speed. Economic systems reflect structure before intention. They reward alignment and expose imbalance without deliberation. Wealth does not move because of ambition, morality, or design preference. It moves because systems translate effort, energy, and organization into output with varying degrees of efficiency. Over time, capital recognizes that efficiency and relocates accordingly. This process is neither hostile nor benevolent. It is mechanical. History demonstrates that permanence in finance is an illusion sustained by momentum. Institutions appear enduring because they outlast business cycles. Currencies appear stable because trust decays slowly. Yet beneath continuity, structure changes. When production migrates, when trade routes realign, and when savings accumulate elsewhere, the system begins to reprice reality. Financial memory lags physical change, but it always yields. Periods of transition are often misunderstood because they lack a single defining event. Observers look for collapse, confrontation, or declaration. Structural shifts do not require those signals. They proceed through quiet substitution. Old systems continue to function while relevance diminishes. New systems grow without asserting dominance. Only with hindsight does the transfer appear obvious. The movement of wealth eastward follows this timeless logic. It reflects production density, reinvestment capacity, and operational resilience. These qualities compound. Once embedded, they attract capital without persuasion. Financial power then reorganizes itself to serve where activity concentrates. This is not a judgment on past systems. It is the outcome of accumulated incentives responding to arithmetic limits. Every historical transfer carried similar misconceptions. Legacy centers assumed permanence. Emerging centers focused on function. The system chose function. It always does. Financial dominance never disappears because of weakness alone. It dissolves when alternatives no longer require it. That moment arrives quietly, then accelerates. Understanding this pattern removes urgency and fear. Transitions are not endings, they are redistributions of relevance. The global system continues to operate, but with different anchors. Wealth remains productive where structure supports it. Influence follows capacity. Stability emerges from alignment, not control. This perspective clarifies the present without dramatizing it. The final transfer is not a climax. It is a phase completion. The system settles where production, trade, and reinvestment reinforce one another. That settlement reflects reality as it exists, not as it is remembered. History is consistent on this point. Structures rise, mature, and yield to successors that better match prevailing conditions. No identity escapes this cycle. No system overrides it. Recognizing that continuity provides understanding. Wealth moves because systems evolve. The logic endures, even as centers change.